Start thinking deeply about investing after listening to Charlie Munger at the Berkshire Hathaway shareholder meeting. His perspective on a radically changed investment world struck me. I want to share these reflections with you, exploring how these changes affect investment strategies. Discussion of Munger's warning. Let's explore in more depth Charlie Munger's warning about emerging difficulties in the investment world. During the Berkshire Hathaway shareholder meeting and in the Acquired podcast interview, Munger repeatedly warned listeners. This reiteration on his part is remarkable, since he does not usually repeat the same points unless he feels they are vital. To fully understand the context, we must consider Munger's extensive experience and acumen in the field of investment. His career has spanned decades, during which he has witnessed and navigated through multiple market cycles, financial bubbles, and crises. This makes him uniquely qualified to assess current market conditions. Munger specifically mentioned that we are approaching an investment period that may be the most difficult he has ever seen. This statement carries significant weight, considering that his career has included extremely tumultuous periods such as the 2008 financial crisis and the dot-com crash. His assessment suggests that investors need to be prepared for a market environment that may be more unpredictable and challenging than previous ones. A crucial aspect of Munger's warning concerns the increasing complexity of the market. He points out that access to information, technological advancement, and an increase in the number of market participants have fundamentally changed the investment landscape. This makes it more difficult for investors to identify and take advantage of unique opportunities, as information is more easily accessible and investment strategies have become more sophisticated. In addition, Munger highlights the importance of taking a cautious and well-considered approach. This means not only having a thorough understanding of market mechanisms, but also being able to resist the temptation to follow short-term trends or give in to panic in times of volatility. Finally, Munger's warning serves as a reminder for investors to remain true to the fundamentals of value investing: patience, diligent assessment of opportunities, and a long-term time horizon. In an age of uncertainty and rapid change, these qualities may be more crucial than ever. In summary, Munger's warning should be considered an important signal to investors at all levels. It calls us to review our strategies, to be more selective in our investment choices, and not to underestimate the complexity of the current financial landscape. Analysis of complexity. Factors in the current market. In this part of the analysis, we will explore more deeply the complexity factors in the current market, as highlighted by Charlie Munger. These factors are crucial to understanding the challenges investors are facing in today's financial landscape. Saturation of financial analysis. The first factor concerns the abundance of financial analysis available. This saturation stems from unprecedented access to financial data and sophisticated analytical tools. In the past, detailed information about companies was available to only a few. Now, with a few clicks, anyone can access a wide range of data. This has led to an environment in which almost every aspect of a company is scrutinized and analyzed by countless investors. This democratization of information, while positive, has made it more difficult to find undiscovered or undervalued investment opportunities. Impact of rising interest rates. The second factor to consider is rising interest rates. This is a key variable that affects the valuation of companies and their ability to access capital at reasonable cost. When interest rates are low, companies can borrow at lower costs, stimulating investment and expansion. However, as rates rise, the cost of debt increases, potentially limiting growth and negatively impacting profits. In addition, higher interest rates make investments in government bonds and other forms of fixed-income investments more attractive than equities, shifting the flow of capital and affecting the dynamics of the stock market. Movement of institutional money from stocks to government securities. The third factor is the movement of institutional money from equities to government bonds. This phenomenon is closely linked to rising interest rates. Institutional investors, such as pension funds and insurance companies, are constantly looking for the right balance between return and risk. As government bond yields rise, these investors may shift a portion of their portfolio from equities, which are considered riskier, to government bonds. This shift may decrease demand for stocks, potentially putting bearish pressure on stock prices and reducing liquidity in the stock market. These three factors combined create a significantly more complex investment environment than in the past. Investors must now navigate a sea of information, consider the macroeconomic impact of interest rates, and adjust their strategies in response to institutional capital movements. This requires a higher level of understanding and analysis to identify viable and sustainable investment opportunities over time. Specific examples of successful investment strategies. We now delve into some specific examples of successful investment strategies that illuminate the principles enunciated by Charlie Munger. These examples not only demonstrate the practical application of the concepts discussed, but also offer valuable insights into how investors can adapt their strategies to current market conditions. Berkshire's investment in Apple. Berkshire Hathaway's decision to invest in Apple is an emblematic example of value investing. Although it was not a traditional stock for Buffett and Munger's portfolio, given their historical hesitancy toward technology companies, the investment in Apple proved exceptionally profitable. The move to invest in Apple was driven by a thorough assessment of the strength of the Apple brand, its solid business model, and its strong market position. In addition, the investment was made at a time when Apple's stock was relatively undervalued, demonstrating the patience to wait for the right moment. This case underscores the importance of a deep understanding of the company in which one invests and of recognizing when a large company is temporarily undervalued by the market. Investment in Japanese trading houses. Another notable example is Berkshire's investment in the 5 major Japanese trading houses. This move was undertaken considering Japan's unique economic environment of low interest rates. This investment was based on Berkshire's ability to access low-cost financing and invest in companies that offered relatively high dividends, creating positive cash flow. This example demonstrates how a thorough understanding of global macroeconomic conditions and the peculiarities of specific markets can open up unconventional but highly profitable investment opportunities, patience-based approach, and careful selection. In addition to the specific examples, it is essential to emphasize Buffett and Munger's general approach to investing, a focus on patience and careful selection. They often emphasize the importance of waiting for the right opportunities and not getting carried away by market euphoria or the pressure to invest continuously. This approach is based on the philosophy of value investing, which favors quality opportunities over frenetic activity. Munger and Buffett have shown that a few well-chosen investments can be far more fruitful than a myriad of mediocre choices. We illustrated how, even in a complex and rapidly changing market, investors can find success by taking a thoughtful, patient, and well-informed approach. They underscore the importance of a thorough understanding of the companies in which one invests, the macroeconomic environment, and the ability to identify unique opportunities that may be overlooked or undervalued by other investors. How to deal with the current investment environment. We will now uncover strategies and methods that investors can use to successfully navigate the current investment environment of unique complexities and challenges as outlined by Charlie Munger. Adopt a long-term mentality. Long-term investing is critical in a fickle and uncertain market. This means resisting the temptation to follow short-term trends and instead focusing on companies with solid foundations and long-term growth prospects. Investors must exercise patience, avoiding hasty decisions based on temporary market fluctuations or overly optimistic or pessimistic market sentiments. Focus on in-depth fundamental analysis. In a market saturated with data and analysis, an in-depth understanding of company fundamentals becomes even more crucial. This includes analyzing financial statements, understanding the business model, evaluating management, and determining the true intrinsic value of the company. Fundamental analysis helps investors distinguish companies that are truly solid and well-positioned for future growth from those that are simply the subject of market speculation or hype. Smart diversification. While diversification has always been a golden rule in investing, in a complex and rapidly changing market, it becomes essential to adopt a smart diversification strategy. This means not only having a wide variety of assets, but understanding how different investments perform under various market conditions. Smart diversification also involves balancing riskier and safer assets across different sectors and geographies to mitigate risks and take advantage of opportunities in different market environments. Maintain flexibility and open-mindedness. The current investment environment requires flexibility and open-mindedness. Investors must be prepared to adapt their strategies in light of new information and changes in market conditions. This may mean reconsidering their investment beliefs, being open to new investment ideas and strategies, and staying informed about global trends and economic and political changes that may affect markets. Use of innovative technologies and tools. The digital age offers investors tools and technologies that can significantly improve analysis and investment decision-making. Data analysis tools, algorithmic trading platforms, and online educational resources can provide competitive advantages. However, it is critical to use these technologies with discernment, complementing them with a sound understanding of investment principles and not depending solely on them to make investment decisions. Continuous training and updating. Finally, ongoing education and updating are essential. In a rapidly changing market environment, investors need to stay up to date on the latest news, investment theories, economic analysis, and market trends. Platforms such as Skillshare, mentioned earlier, provide learning opportunities in various fields, including investment, economics, and financial analysis, helping investors stay informed and knowledgeable. In conclusion, dealing with today's investment environment requires a holistic approach that combines patience, in-depth analysis, smart diversification, flexibility, strategic use of technology, and a commitment to continuous learning. These elements together can help investors successfully navigate through today's complex market scenarios. Closing with personal reflection and call to action. Dear listeners, as we conclude this journey through the challenges and opportunities of the investment world, we want to leave you with a final call to action that can serve as a beacon in your investment journey. First, set a learning objective. Choose a topic or area of the investment world that you want to learn more about. It can be something specific, such as fundamental analysis, understanding emerging markets, or exploring new forms of investing, such as cryptocurrencies. Dedicate time each week to expand your knowledge in this area. Second, actively participate in the investment community. Join online forums, participate in webinars, join local or online investment groups. Sharing ideas and strategies with others can offer new perspectives and help you refine your investment techniques. Third, practice what you learn. There is no better way to learn than through direct experience. Consider creating a test portfolio or investing a small amount in an opportunity you have studied. Remember, mistakes are part of the learning process. Fourth, reflect regularly on your investment journey. Take time each month to evaluate your investment choices, progress toward your goals, and lessons learned. This reflection can be crucial to your development as an investor. Finally, remain curious and open to change. The investment world is constantly evolving. New information, trends, and opportunities are constantly emerging. By keeping an open mind and active curiosity, you can stay ahead of the curve and adapt effectively. Remember, the path to becoming a wise and successful investor is an ongoing journey. Each step you take is an opportunity to grow, learn, and improve. I am excited to see where your journey takes you and hope to be a useful resource along the way. Thank you for listening, and participating in this discussion. Now go, explore, and turn your knowledge into action.